even as we've gotten into earnings season, and the bank's reaction has not been as positive. But there seems to be a lot of optimism still going into this earnings season.
There is, and I think we are in that camp. We do expect in aggregate earnings to be up double digits this year. And what's important to note is that's happening at a time when we are not necessarily benefiting from any base effects. In other words, last year was also very strong. We saw momentum continuing from Q1 to Q2 to Q3, and we do expect Q4 to moderate a little bit, but you'll end up with double-digit earnings even in 25. So that's a very strong setup, for example, compared to Europe, where earnings have been flat for 3 to 5 years, and there's expected to be some pickup from there, right? So the setup is very good. We do think that tech and the broad TMT space remains central to getting where we want to. To the extent that a space wobbles, we have a hard time seeing the market managing to push through without their leadership.
And when we talk about leadership or not, lack of leadership, your team recently did some work on single stock volatility, the individual moves we see in stocks, which tend to be then magnified even more during earnings season as we're seeing the reaction to earnings. But when we're seeing so many individual sort of idiosyncratic moves, what does an investor kind of do with that?
It's very interesting because one of the interesting things, and we expect that to continue this year, is like you noted that dispersion within single stocks of returns has been extremely high. The corollary to that is the fact that the correlation, whether it is between sectors or for stocks within sectors, or for stocks within S&P itself, is at historic lows. So in principle, this is an extremely good environment for stock picking and hence for active management. But the caveat is that returns still continue to be very concentrated. So if I look at the rolling 12-month returns, even now, or at least only 35% of stocks in S&P have done better than the index returns, right? So returns do get concentrated. If you look at the top 10 contributors to S&P returns last year, not surprisingly, 5 of the big tech 6 stocks are within those. So I think it's a very tricky market where in principle it is a stock picker's market, but navigating that is not going to be easy. And to your point, one of the points we noted was the volatility attributed to earnings has increased to the highest levels in a long, long time. So, and that's partly to do with the fact that information dissemination is moving very fast. So people are processing information, reacting, but that doesn't necessarily make an investor's life easier in navigating that. The last point I will make is that even big tech, on which we're very positive, which by the way is close to, call it 35% of the market and accounts for well over a quarter of S&P earnings, the correlation between those 6 stocks itself is hitting multi-year lows, right? So it was either ways to begin with in the 40 to 50% range in the past, call it a few years. Now we're in the 20 to 25% range. So if you can navigate even these 6 stocks, it can turn out to be great. But that's not to suggest that navigating and timing that is an easy task.
No, it doesn't seem like an easy task at all. I mean, and not only is it hard to perhaps look at the market from a macro perspective, sort of that quote unquote top-down perspective, but even applying sort of thematic lenses might be somewhat challenging. The growth versus value debate that has come back, or looking at certain sectors within the market because of that dispersion. Do you not want to buy the whole S&P 500 right now? You want to just go in and look at individual stocks?
Well, to the extent that you're confident in doing that, but it's going to be treacherous and tough. But owning the index is not a bad option at all. And I think, but if you look back, our own view is that, we actually remain positive on fewer sectors, as opposed to buying everything,
Gotcha.
Right? So we continue to like tech broadly, and within that big tech even more. We like financials and we like utilities. But the underlying theme which continues to dominate the market is a broad AI theme. And our core conviction is that it'll sustain this year, even though the level of scrutiny around that has decidedly increased. So we are now in the 4th year of this AI cycle. And as some of these big hyperscalers are increasingly tapping the public and private credit markets. There's an extra pair of eyes in terms of scrutinizing what the underlying fundamentals are, what the balance sheet strength is. And the credit market itself is being very efficient in terms of pricing the risks across. So in other words, if you look at where the credit default swaps or spreads are of an Amazon or a Google, is very different than what it is for Meta, which is in the middle, as opposed to, let's say, an Oracle, which is another spectrum. So I think the market is sorting things out, but the theme is very much in place. AI adoption is expanding. The big hyperscalers are already monetizing AI to a substantial level in their own core businesses, and the use cases is expanding. That said, enterprise usage is still quite low. So I think the whole play now has entered a different phase of applications down the line for a wider adoption. But as we wait for that to unfold, I think tech, especially the big tech, and AI as a theme, is the core of this market.
And it's interesting that you say that, because we were talking during the break about how we came back from our holiday breaks, rested, ready to go, and it has just been headline after headline, Truth Social post after Truth Social post coming from the president that have created some turmoil in the market. Is basically what you're saying, like AI is the more powerful force, and maybe try to disregard some of that headline risk?
Yeah, broadly speaking, I think the lesson from 25 is to ignore the policy-driven sort of chaos. And I think the message is broadly the same. The tricky part is every now and then, some of those policies are indeed translating into something very tangible. So what is the direction of that is important. And of course, this year is the midterm elections, so you can expect more, what should I say, policies more friendly towards sort of that process, but that has different implications. What does it mean for the deficits, which have been actually going in the right direction, but what does it then mean in the credit markets? Right now, the rates market, for example, is very benign. The 10-year is still sitting at 415. We are not in danger zone at all. Equities have done well. But to your point, though, the policy uncertainty is adding fuel to this dispersion we are talking about, where at the index level, things are relatively calm, including with the VIX. But at the single stock level, the volatility is very high. And if you look at each of these pronouncements, whether it is about credit card capping fees, whether it's about the ability of institutional investors to buy into the housing market, with the defense companies being able to buy back stocks or pay their in compensation, each of these has caused a lot of volatility in individual stocks for a brief period of time. And the question is, how realistic is it and how likely is it that it translates? So in the case of financial, for example, we remain very optimistic. I think valuations are decent, capital market activity is humming, M&A activity is likely to pick up, the yield curve is already steepened, I think it will remain steep, which is good for their fundamentals. So I think you have to have a thick skin and be able to look beyond the chaos while tactically navigating the market from time to time.
It's been an interesting morning, hasn't it? Because Goldman and Morgan Stanley both reported the stocks kind of languished a little bit and then have been perking up after the conference call. Devin, you and I were emailing a little bit as I was trying to get my hands around what was going on there. In your mind, what were sort of the key things that were said on the calls that maybe turned the sentiment here?
Yeah, good morning, Julie. So, I think that the point is the bar was really high for these companies heading in. So even though they both beat numbers pretty nicely, that was kind of baked in expectations. I think most on the buy side assumed they would beat. So then therefore, it all became around what they were going to say on the call and what they were going to give in terms of kind of new targets. Were they going to address the old targets and update? And Morgan Stanley, they didn't increase the return on tangible common target, which I think most people were hoping they would. But positively, they addressed it on the call. And effectively, I think investors are walking away feeling like, they'll probably continue to beat that number. And it's just more out of conservatism. So I think that's the Morgan Stanley nuance. And so people feel quite a bit better exiting that call. And then Goldman Sachs really kind of came out swinging on their old targets, particularly around asset and wealth. And I think setting a much higher bar for themselves and reaffirming their mid-teens ROE through the cycle or kind of over the medium term, but with the expectation that there's a lot they can do on capital, still kind of $30 billion plus of buyback authorization, and that's going to be a tool. So I think people also feel pretty good there with a very constructive capital markets tone on the call, plus some self-help here as we go into 2026. So it was really about the outlook because we all knew that the quarter itself was going to be really strong.
Yeah, and speaking of outlook, Steve, Goldman in particular, that equities trading revenue number was just kind of incredible there. A record for any bank ever at $4.31 billion. Do you expect the momentum, not just for Goldman, but for some of the other capital markets businesses across Wall Street to continue to see that performance?
Yeah, Julie, we do. I mean, this is a unique environment, obviously, for the investment banks right here. It's really a perfect storm in a good way. You've got a great backdrop. You've got good fiscal monetary policy. You've got rising boardroom confidence. You had global announced M&A deal value was up over 40% in 2025. So I think a lot of those deals still haven't closed. So there's some of that backlog still that will generate into revenues and moving into this year. So. It's really across the board. I mean, it's the trading volumes have been good based on volatility. It's across equities and fixed income, currency, commodities. The M&A story, continues to stay high. The boardroom confidence is getting better. There's a lot of competitive pressure on the side of corporates to either grow revenues or cut costs, which can be done through M&A. That more favorable regulatory environment that we've talked about most of this year, adding to deal demand, and particularly these mega deals, especially in vogue, with a lot of that driven by the need for scale, whether it's across technology, industrials, financial sectors. So all combined, that's a very good backdrop for this year. And let's not forget falling interest rates and more favorable financing terms, right? So the market has been willing to absorb new debt, new equity. And that is a prerequisite to keeping that M&A story going.
And the banks themselves have also been engaging in some M&A. And with Goldman in particular, obviously the big headline was selling that Apple Card portfolio to JP Morgan. Devin, in the wake of that, do you feel like the course correction at Goldman out of that consumer business is complete? Do you expect any other additions maybe at Goldman this year, maybe on the asset management side? Or do you think that this is the Goldman that David Solomon wants and that the street wants?
Well, I think this is the Goldman that the street wants. And that course correction, I think, is, to your point, that the Apple movement was like the primary remaining piece there. And so I think that's an important moment for the firm to really think about the future. And then to your question around incremental opportunities, I still think they're going to be looking at M&A. They've done some tuck-in, particularly in the asset and wealth side, and I think that's an area where they can still grow. They're putting up some really big targets for the alternatives business, where they are expecting $75 to $100 billion of net inflows annually in that part of their business. So very focused on kind of leveraging expertise and scale there. 2030 target for $750 billion in alts AUM. So that's like as big or bigger than most of the publicly traded alternative asset managers today. So I think they're really showing that this is an area, and it has been going on for the last several years, but where they can differentiate Goldman's franchise, and also an area where I think you'll see continued growth focus, M&A, to your point, and the point around kind of capital relief and excess capital. And there's a lot of ways you can both reinvest that back into the business to grow. You can return it to shareholders through dividends and buybacks, and they increased their dividend today by 50 cents. And they talked about being selective on buybacks, but that's still being an important tool. And then you can do M&A, and I think that's very much on the table, and maybe increasingly so, just with with some of the capital changes and regulatory relief that we're seeing here.
That said, Devin, I do want to follow up on that, because you do have a market performer neutral equivalent rating on Goldman and on Morgan Stanley. Are they just too expensive right now?
We've been bullish on both these companies for quite some time in the not too distant past year, and we just got into a phase where we do think that the valuations are reflecting a lot of our enthusiasm. And so there's a couple things going on. The fundamentals could not be better, and you heard that from the call today, and things are actually getting better into 2026. And I think that's supporting investor enthusiasm, and a lot of active managers rotated into these names early in 2025. I think a lot of the incremental buying over the last 6 months has been more passive So you had $30 billion of net inflows into ETFs and financials, which is massive for financials over the last year. And so I think that's been a big piece of driving the valuations to where they are today. So we feel like they're getting a lot of credit, but I think when you take a step back, if you have a 3 to 5 year horizon here, I think you do well. In the very near term, we're taking a pause to try to digest some of the recent stock move. But, I think it's the valuation versus the fundamentals. Fundamentals really couldn't be better, and I think are actually accelerating. And in some ways, today's update was even marginally better than I think people were hoping for.
And Steve, you're weighing it a little bit differently because you have buy equivalent ratings on both these guys. So do you see any risks out there to that upside case that you have?
Well, I think as Devin said, yeah, the consensus about the profit growth this year is probably intact. A lot of things could happen, obviously, on the global side or regulatory or what have you to upset that story. But no, I think this is a stair step higher for valuations for these banks. Even a Morgan Stanley at say 15 times next year's earnings. You've got this incredible backdrop, I think, of a strong momentum that's likely going to be here, several years, as long as the present administration is helpful with that backdrop, whether it's the fiscal policy, the AI trade that, as I mentioned, the need for corporates to get more efficient and grow revenues. So, there's a lot of capital markets formation that's possible here, and I think generally when you have this move higher in the capital markets trade, generally you'll get a stair step higher in valuation. So I think it has a little bit longer to run here. I think at least through the administration currently, and we'll take a pause potentially after that. But these banks are in great shape, and typically the valuations themselves are I don't think are a hindrance at this point.
Ted, it's always great to see you. I was indeed struck by that CapEx forecast. I mean, everybody's raising their CapEx forecast, it seems. And so TSM kicking things off this year, $52 to $56 billion is what it's expecting. What did you take away from that and from the rest of the results?
Well, the CapEx is very interesting. It's up 32% for 2026, which is a huge number. And what that represents is really the core demand they're seeing. The cloud titans think that TSM is essentially the bottleneck for AI on chip manufacturing. So that CapEx number was above the street, and that's why all the semi-cap equipment names are rallying. But there were some other metrics coming out of the call that are equally important. TSM is going to grow at 36% versus the broader foundry index at, call it, 16%. The other thing is on the high performance compute side, which is 55% of their revenues. Think of that as just Gen AI. 18% of their total revenues are now Gen AI, and they can't meet demand. The last thing is this 2 nanometer node is the magical node from performance and power. They are at least a node and a half ahead as it relates to a technology advantage from any of their competition on the foundry side. So they've really got core dominance going on.
How should we be thinking about TSM in terms of what's going on between U.S. and Taiwan? Of course, we're working on a trade agreement with them, and I expect there's some expectations that they're going to be building more in the U.S., but how should investors be thinking about that?
It plays into the geopolitical that is not in this market. If you look at TSM's revenue, 74% of their revenue is going to the U.S., and they are accelerating their fab construction in Arizona. They're actually pulling it in pretty dramatically. They're investing $167 billion into the U.S., and that gives the U.S. a huge advantage, not only on AI, but also on defense capability. A lot of those defense silicon is done at the 5, 3, and 2 nanometer node in the future. So it's really providing a wedge between the U.S., and through our policies of the Trump administration, the U.S. and China. So again, U.S. is 74% of TSM's revenue. China's only 9% of TSM's revenue, and they're restricted on any of the leading node productions under 14 nanometers. So from an economic standpoint and a technology standpoint, it really favors the U.S. and quite frankly plays in the geopolitical argument.
Yeah, it definitely seems that way. I was struck on the broader AI note on a comment that the CEO, CC Wei, said on the call. He was asked something by an analyst, and he said, "You're trying to ask us whether AI demand is real or not. I'm also very nervous about it," he said. He talked about how much they were spending, and he said, "If we don't do it carefully, that'd be a big disaster for TSMC." This seemed pretty honest, right? That like they're worried about the same thing that everybody is asking questions about. But is it sort of, I mean, they are putting their money towards that, so they must have some high degree of confidence.
I think they've got visibility through the cloud titans out anywhere from a year to 2 years. And when you have that visibility and they're controlling the purse strings, if you look at Google, Microsoft, Meta, they can all support this CapEx through their existing businesses. And they're giving TSM visibility out that they have confidence on building out that CapEx and running these fabs at very, very high utilization. One thing that also came out on the call that I think is noteworthy is their gross margins came in at 62.3% versus 59% year over year. They are killing it as it relates to utilization and cost takeout. So they're really the key for the cloud titans on bringing this AI infrastructure to light.
Do you think that investors should own TSM itself? Do you own everything that sort of touches it? I mean, as we know, this is a very interconnected web within this new Gen AI build out. So how do you think about investing in it?
I think 25 was easy. 25, all boats lifted. I think 26 is going to be more volatile, and you really have to segment your buys. From the cloud titan perspective, we're trying to favor companies that have really, really good free cash flow, and again, that their core businesses support this CapEx, like a Google, Microsoft, a Meta. Apple, very controversial. They're behind as it relates to the AI trade. When you're asking another cloud titan to power Siri, that's Google, that rubs a fair amount of my clients the wrong way. As it relates to semi-cap equipment, there are roughly 3 plays if you want to do the bundle of ASML, AMAT, and Lam. And then from the semiconductor side, I think NVIDIA is obviously the biggest derivative coming out of this report. I think what people are missing on NVIDIA is their software dominance, their development of 3 to 5 years ahead of anybody in the eco chain. That's an overweight in our humble opinion. And then there's some specialty semis that play on this infrastructure area that were cyclical that are now turning into secular plays. Like look at APH, Amphenol, or look at the entire optical group, whether it be Ciena, Coherent, Lumentum, even Cisco or Arista, that build out on the infrastructure side, as well as memory, obviously Micron, SanDisk, Samsung, and SK Hynix. Mm-hmm. We've got 2 years of unbelievable demand in front of us. So you've got to be very, very specific.
Very specific. So it seems like 26 might be harder than 25, but it seems like there's still a lot of opportunities. And thankfully for our viewers, you enumerated a number of them there. Ted, it's great to see you. We'll catch up again soon.
Okay, Julie, take care.
Thank you.
How much of a roadblock is this for the crypto industry?
It's a significant setback. I think the crypto industry was really hoping that we would get this bill. I think it's still hoping that we would get this bill. You know, we said at the beginning of the year that passage of this bill would mean that Ethereum and Solana would trade to new all-time highs. If it's now uncertain, and it looks a bit uncertain, I think the outlook is a bit uncertain. There's still hope. There's still reasons both to expect this bill and to expect a good year for crypto. But be sure, this is a setback.
Matt, I'm going to assume this gets done, whether it's in a couple days, a couple weeks, that this gets done. What happens after this legislation passed? What should investors know?
Yeah, what this does, and I'm with you that it will get done. The old saying is that bills have to die 7 times in Washington before they pass. This is, I think, its third death. So let's be optimistic. If it does pass, it creates a firm regulatory framework that will last for years. Right now, crypto has done well over the last, let's say, 2 years because we've been in a positive regulatory swing. Washington has been in favor of crypto, but that could switch with a new administration. What this bill does fundamentally is make it so that that won't switch. So crypto has a strong foundation to build on. There are lots of specifics to it, but that's the big one. Do we have a big, strong foundation for which we can build a new financial industry?
I loved your 2026 predictions you sent along. I want to go through a couple of them. One, more than 100 crypto-linked ETFs will launch in the U.S. How will that change the ETF industry? And how should investors, assuming even half of these launch, even 10 of them launch, how do you go about investing in one of them? What do you need to look for?
Yeah, well, it's like the rest of the ETF industry, which has thousands of ETFs, but most of your money are in a few. Most investors will be best served by diversified crypto index funds. We run one, BITW at Bitwise, that gives broad-based exposure. But what you'll see out of these ETFs is a lot of individual asset ETFs launching on exciting new assets. We just launched one on Chainlink. A lot of thematic ETFs that give exposure to stable coins, tokenization, AI, and other themes. I think the right framework is the traditional ETF industry. Most of your money in a diversified index fund, and then use these exciting new launches to nibble around the edges and indeed ignore some of the more far off, unusual ones.
I wanted to leave a little time for this one. Another prediction you have is Bitcoin will be less volatile than NVIDIA. Now, when I think NVIDIA, Matt, to be fair, I think about strong free cash flow, strong earnings reports. I know what they're doing. I mean, Bitcoin, despite all of its advances, I mean, the industry is still, it's opaque and it's tough for people to understand it. Why do you think this is going to happen?
Well, here's the incredible thing. We are sort of gifting ourselves a prediction here because last year, Bitcoin was about as volatile as NVIDIA. One of the things I love to do when I speak with institutional investors about Bitcoin is update their priors. People think of it as this wild and crazy market. How could you put it in a portfolio? Actually, for the last year or so, it's been about as volatile as the average tech stock. This is not your grandfather's Bitcoin. It's now a mature institutional asset, still with a lot of upside, but a lot less volatility. We just think what's been happening for the past few years is going to continue this year as institutions leg into this trade, which is what we're seeing to start the year.
One more, Matt, before I let you go here. Bitcoin's correlation with stocks will fall. Why?
Yeah, absolutely. Well, just think of everything that's impacting the stock market. Concerns about the AI bubble, invasions of Venezuela, sort of government policy. You have a lot of things that are impacting the stock market that don't impact Bitcoin. It's being driven by other factors. It's being driven by fiscal debasement. It has this huge institutional investment going on. They're just being driven by different things. And as Bitcoin matures, it's going to increasingly act like its own thing, not like a risk-on asset, but as a unique asset that fits into portfolios and makes the whole portfolio perform better.
All right, Matt, thanks so much. Good to see you. Have a great rest of the week. Appreciate it.
Thanks for having me.
We're a year down the road with the Chinese competitors. They're now even more prominent around the globe. Not a lot here in the US, but you go to Europe, you go to anywhere else, China's a big deal. Number two is partial electrification, hybrid, EREVs. EVs are now starting to change, and the partial electric world is actually the most exciting part of the, and then I would say, tariffs are still a big topic. And that's something that's very much on our mind in managing.
Yeah, I know President Trump talked about, do we need USMCA for Canadian products? I know you have thoughts on that.
Yeah, USMCA is critical for our country. We developed the whole assembling automobiles across all 3 countries. We need revisions to it. It's not fit for purpose today. The tariffs do change a lot about the aspects of USMCA, but for a company like Ford, who makes the most number of vehicles by far in the US, like 80% of what we sell are made here. Our competitors aren't even close to that, the mainstream competitors. This is a critical negotiation. It should start sometime this spring, and I think every customer should care deeply about USMCA.
You mentioned China as well, and their EV prowess sort of front and center with the industry. Yes. Ford with the pivot last year at the end of the year, kind of going more towards the smaller EVs and E-revs and
that's right.
And however you want to say it.
Exactly.
What do you think the industry, Ford, even us journalists and Wall Street got wrong about the EV transformation, or is it just a delayed sort of onset?
No, it's not delayed. I think it's actually different. I always portrayed it like a baseball game. We were in the second inning. Most people thought we were in the eighth inning. We're actually in the second inning. We're now going in a third inning. And I think all of us, should be humbled by the fact that we're at the very beginning of this journey. We are not in the middle or the end. Battery tech, infrastructure, it all changed a lot. It took us 100 years to build out the petrol infrastructure. The electrical infrastructure is going to take a lot of time. It may not take 100, but it's going to take time. I think what we got wrong, I think what we all got wrong is, look, policy has a huge impact. When President Trump says no EPA rules anymore, that is a game changer for the companies. We were artificially selling EVs and hybrid at mixes that were not in line with customer demand. Now we're doing that, and that changes your allocation of capital. But I think anytime a new technology, software-defined vehicles or electrification, both of those are separate, but they're connected. When they rip through a new industry like auto, you got to understand that in the first couple innings, it's going to keep changing differently than we think. And I like to say those pesky customers, I love that term because the customers are awesome and they act rationally. They're not going to buy a $70,000 vehicle that only goes 300 miles if they don't really want to charge on the fly on a long trip. And we drive long distances in the US. And we found out they're just not going to do it. Some people will do it at a Tesla Supercharger now, or a Lightning customer or Mach-E, but most customers like, nah, I'll buy a hybrid, and we think they'll buy an E-Rev. That is a really cool tweener technology.
Yeah, that Lightning E-Rev coming up in a couple years. Would,
I think people will be shocked. It's an all-electric vehicle. Yep. It is not a hybrid like the F-150 hybrid. It doesn't have a gas powertrain to drive the wheels. The gas powertrain is an industrial engine to charge the batteries. It's a completely different vehicle, but for towing, work use, long distance, it's an electric vehicle that can power itself with gas charging.
I know you did that EV road trip in America, and kind of curious how that would be with the E-Rev, right? Maybe a different story altogether.
Yeah, I wouldn't
right?
stop. I wouldn't be stopping at Supercharger Networks or Charge America. I'd be stopping at gas stations.
Speaking of gas stations, we're in Detroit, Motor City. You guys unveiled two cars here, specific cars, enthusiast cars. The Dark Horse SC, which is sitting right there across the way here. Also the Bronco RTR. Two different products, but targeting enthusiast customers. Why is it important for Ford?
That's our whole brand, no more boring cars. What I love about both products is Vaughn is something new for Bronco.
Vaughn Gittin.
Vaughn Gittin Jr., like his whole DNA was a drifter. So like Ford's working with him on an off-road vehicle, but he's been racing at Baja with us. And he loves off-road racing. And also the SC, it's not Shelby. It's something different. We're going in a different direction now. We really want to connect our vehicles to racing. With the Mustang Challenge and our GT4 and GT3 race cars. We really see Mustang lineup being built out around as an enthusiast brand. Yes, you could rent one in Florida and drive it down to the Keys as a convertible.
That's not a bad idea.
But I think we really feel like Porsche shouldn't be the only brand having fun, and we're going to do it in a Detroit way and differently. We want to make a stick shift affordable V8 coupe, unlike some of our competitors here in Detroit. But we also want a drift RTR Mustang. We want a supercharged, more affordable version of the GTD. We want a GTD. We want Bronco to not be just the old style off-road. We want Vaughn Gittin Jr. to remix an off-road category. We are not going to be stale trail people only. That's what's fun about being in the car business. We want to challenge ourselves to reinvent the enthusiast products on and off-road in a way that maybe people didn't expect.
I know you're really hot on Dakar and
Yes.
with the Bronco there, and you guys, knock on wood, have a good finish there. I know.
Yeah.
I know you want to talk about that, but also we got to mention the season launch
Formula
today.
One, yep.
Formula One.
Yes.
Ford returning to the
Yes.
top flight of motorsport.
Yes.
It's a big deal, obviously, for American fans and for the F1 in particular. But it's not just a marketing exercise, which many people thought. Right? It's beyond that. It's engine and DNA, right?
Yeah, we've been working for 4 years. We have lots of engineers in Milton Keynes. It's been a lot of work for 4 years. Today we get to celebrate that, and then we'll be on track in Barcelona and beyond. It's going to be very challenging. We are not like Ferrari and Mercedes have been building a PU for 20 years. The DFE got us to the third most winning brand in Formula One with our power unit. But the tech transfer is no longer 4 valve per cylinder and overhead cams. It's now, predictive failure components and software that we can put in a transit van, or, more aero that we can put in the new UEV affordable electric vehicle, or high discharge batteries that we may use in a performance hybrid system, that we can transfer from Formula One. So the tech transfer, and that's kind of our bet in Formula One on the PU side, the power unit, is really to move that tech into our core product, but not in the old school way of powertrain. It'll be in areas like, batteries, software, and aero.
And real quick, so Red Bull basically is leaning on you guys for hybrid tech and things
Yes.
like that, right?
Yes.
More than
Yes.
they thought they would?
Oh, for sure. I mean, we've had a lot of surprises the last 4 years. It's been a lot of hard work. We brought a lot to the table. I'm really proud of my team. We've been 3D printing components for the PU and shipping them over there. We have actually engineers flying over to Milton Keynes with prototype parts over the last 4 years because our 3D printing capability was higher than the Formula One teams. We have a lot of experience with hybrid. We have a lot of experience with control software. And we can bring a lot to the table that even a great Formula One team like Red Bull doesn't have the resources of Ford Motor Company. But in the end, this is a really huge mountain to climb. We're very humbled by this approach. We've been involved we have so many engineers involved in the project. We really know how hard this is. Some of our competitors, even crosstown competitors, are racing Ferraris and other people's PUs. We're going to do it ourselves. And because it's hard. And there are no guarantees.
It's good that you have a test driver like Max Verstappen to test that technology. We'll talk to him later today. But quick last question. I want to talk about the Detroit Auto Show and Ford, the connection to the city.
Yep.
You guys are doing a lot here. Why is this so important for Ford?
Well, because we believe in the rejuvenation of Detroit. It's Henry Ford's home. We invested over $1 billion in the train station.
Here, right? Yeah.
We're really proud that people can come here and see what Detroit will be now with the tech hub. And we never walked away from the Detroit Motor Show. A lot of our competitors did. When they went bankrupt, they didn't spend money. Last couple of years after COVID, we always had test tracks. We always had introductions. We love our Detroit Motor Show. It's our home event, and it's also a huge charity event for the community. I think for us, the Carhartt partnership really captures the spirit of the company. Tools for technicians, training to get more technicians in our dealerships, Carhartt stuff for our employees. We love Carhartt. It's older than Ford. It's a Detroit company. It's for people to work with their hands. Other than enthusiast products, what we're really good at is work products. Like Pro, like Transits and Super Duties, and we really love Carhartt as a brand. I can't wait for people to see the Carhartt Super Duty. If they thought the Harley truck was cool a few years ago, they are going to love the Carhartt Super Duty.
Governor Barr, thank you so much for sitting down with me. It is great to have you on Yahoo Finance.
My pleasure to be here.
I want to start the conversation with the grand jury subpoenas that were served to the central bank by the Department of Justice and the investigation into Chair Powell. How did you learn about it? And when you did, what was your reaction? How did you feel? How do you see this?
Well, I think Chair Powell's statement from last Sunday was clear and direct on this point. It is an assault on the independence of the Fed, as was the earlier assault on Governor Cook. And I think these are just examples of the ways in which the independence of the Fed is being challenged. And I want to assure your listeners that we are acting only for economic reasons. We are acting only according to our congressional mandate. That's to make sure that we have price stability and maximum employment. That's what we've been focused on all along, and that's what we will stay focused on.
Are you worried that the independence of the Federal Reserve is under threat, and will you personally take steps to protect that independence?
As I said, we are acting only for congressionally mandated reasons. We're acting only in order to assure maximum employment and price stability. That's what we have been doing. That's what we will be doing. And the best way to demonstrate that to the American people is to do that.
Let's talk about inflation. We got some new readings on inflation this week. CPI on a core basis has been sitting at 2.6% for the past 4 months. We also got some readings on wholesale inflation. How are you looking at inflation now, as well as specifically the impact of tariffs on prices? And how much signal are you taking from the data now, given that we are still seeing a bit of a lingering impact from the government shutdown?
Well, the recent inflation data reinforces the concerns that I've had that inflation remains elevated. In core PCE terms, it's been hovering at about 3% over the last year. Services prices inflation has started to come down. Goods price inflation has been rising. Those are kind of offsetting. The balance is that inflation has been too high over the last year. We had a period of time where we made substantial progress from 2022 to 2025. That progress right now has flattened out, and we need to continue to do the work necessary to bring inflation all the way back down to our 2% target. Tariffs are having an effect on prices. We're seeing goods prices rise. The question is, will that be a one-time event where they rise and then they're done rising, and then we'll start to see inflation fall back towards our target? Or might we see persistence of that? And that's really what I'll be focused on the inflation front.
And what's your perception now? Do you see a risk of inflation becoming persistent, especially when you looked at the Beige Book and we saw some of the anecdotal evidence there when you looked at the PPI report?
Well, I do think we're going to continue to see goods prices rising in the early part of this year. I think a reasonable base case is that price increases stop going up once tariffs are fully incorporated into prices. But there's a significant risk that they don't, and that's the risk that we have to watch out for. So we're looking at the labor market, we're looking at the inflation side, we're balancing those risks. I think right now we're in a good place in terms of our interest rate policy to be able to take some time and really assess the inflation effects over the course of the next year.
I do want to get to the path on policy, but you also mentioned the job market, and the Fed cut rates 3 times the tail end of last year on concerns about the job market. Right. We got the December employment report. The unemployment rate dropped to 4.4%. Do you think things are stabilizing now in the job market, albeit perhaps at a lower level?
The job market does appear to be stabilizing. It's a little early to know for sure. We're still working our way through the data. It'd be useful to have some more data at the early part of next year to assess that. As you said, it's stabilizing at a very low level. So if you look at net job creation, it's hovering close to zero. The reason that the unemployment rate has stayed low and has stopped going up is that labor force growth is also very close to zero. Both those numbers might be a little positive, they might be a little negative, but if you think about it, we're not seeing a lot of dynamism in the labor market. On the positive side, it's a very low firing environment. We're not seeing a lot of layoffs of significant size. But on the downside, we're not seeing a lot of hiring. We're not seeing a lot of net new job creation. And so when you have that kind of low level of activity in the labor market, that does present a risk going forward that we need to watch carefully.
When you look at both sides of your dual mandate, are you more worried about inflation now versus the job side, or how are you looking at things now?
I think the risks are pretty much in balance. That's why I think that we're in a good place in terms of interest rate policy to look at those risks going forward. A reasonable base case is that the labor market is continuing to stabilize and that inflation will continue to come down to 2%. But there are risks to both sides of the mandate, given the low level of job creation, risk to the employment side, given the potential persistence of inflation, risk to the inflation side of the mandate. So I really do think we're going to have to take some time to really assess the incoming data. Really until the spring, we're going to have effects of the government shutdown playing into biases in the data for technical reasons on both the employment side and the inflation side. So we have to try and make adjustments for that. We need to treat the data, with some caution, and that will play through really into the spring.
So we're less than 2 weeks away from your policy meeting. You said you're in a good place with policy right now. If the meeting were tomorrow, would you hold rates steady?
Well, we always take things on a meeting-by-meeting basis. We still have a couple weeks till the meeting. I would say that I think we're in a good place on policy. We can take some time to make a judgment about how the economy evolves, how the data is evolving, what the forecast might look at, the balance of risks. But right now, I think we're in a good place.
Looking farther out towards the end of the year, I recognize we're in January. A lot of things can change. But do you perceive any adjustments to the policy rate, perhaps later this year, any rate cuts?
Well, I don't think it makes sense to lock in. We really need to know what is the data telling us and how is our forecast evolving, how are the risks evolving. But I think we can take some time really to assess the incoming data because our policy is in a good place. It is balancing both of those risks, I think, quite well. Right now, we're in what most people think of as the wide range of neutral. Mm-hmm. And so it's really important for us to be careful to take our time to get it right.
How restrictive do you think you are right now?
We're really in the range of neutral right now. Mm-hmm. So,
okay.
You can think of estimates around that, but.
Okay. Sort of switching gears, President Trump set to announce a new Fed chair soon. We know that he wants someone who is in favor of lower rates. How do you see the dynamic of a new Fed chair playing out with the rest of the committee? Do you see any shifts to the Fed being able to act independently?
I think that the committee, the FOMC, is set up in such a way that a new incoming chair, like any chair, has to get the trust and confidence of the whole committee in order to make changes in policy. So the chair has to act based on data, has to act based on reasonable forecasts and an assessment of those risks in a way that convinces other members of the committee that moving or not moving is the right thing to do. So the checks and balances that are built into the system will keep the Fed independent and focused on our goals.
Governor Barr, thank you so much for your insight. I so appreciate it. Welcome to the conversation there.
My pleasure. I really enjoyed it.
We saw record ETF inflows in 2025, and investors are still bullish for this year, with half of ETF investors saying they could see their entire portfolio in ETFs in the next 5 years. Some are even considering pulling money from individual stocks in favor of ETFs. This is all according to a new study from Charles Schwab. And let's bring in David Botzett, Schwab Asset Management Head of Innovation and Stewardship, for this week's ETF report brought to you by Invesco QQQ. Thanks so much for being here.
Thanks for having me, Julie. Great to be here.
So, David, I think we all sort of know on an anecdotal basis how popular ETFs have become. What I think is interesting about your study is just how popular and kind of what's driving it. So put some numbers around it and the enthusiasm that we are seeing around ETFs.
Yeah, I think first and foremost, you had the number on the screen. We saw in 2025 that strong investor appetite and affinity for ETFs come in the way of flows. $1.5 trillion in flows in a single year. I've been in the ETF industry for a long time. I remember when the ETF industry as a whole was only $1.5 trillion. Now we're seeing that level of flows come in a single year. we're also seeing asset managers like Schwab Asset Management meet that investor demand by bringing new and innovative products to market to really help investors meet their long-term investment objectives.
David, as somebody who's been in this industry for a while, as you just mentioned, like what has been sort of the tipping point, or what has been, or maybe there have been multiple, what do you think has been the thing that has driven that popularity?
I think there are probably 2 or 3 things that really drive that popularity. One is accessibility. Investors have indicated in this study we've been doing over a decade that ETFs provide them accessibility to asset classes and easy entry points. That intraday tradability and the ability to access is really a strong point. Number 2 is the cost. ETF investors also indicate that ETFs allow them to help reduce the cost of their overall portfolios, and we know that reducing costs lead to better long-term outcomes. And number 3 is just the increase in market education and acceptance of ETFs. ETFs have been around for over 25 years. Increasingly new entrants into this market, like the millennial generation, have always had ETFs around. They've known about ETFs since they were young and have that willingness and ability to go into ETFs and a great knowledge about ETFs.
Yeah, and indeed, as you found in your survey, that millennials are the ones who are really driving this by the largest percentage here. What do you think about the role of ETFs in 401ks? We have seen some adoption in those plans, but they're still very reliant on mutual funds. When does that start to change in a more decided fashion?
It has been a barrier to ETF growth and getting into retirement plans, primarily 401ks. Now, we have to think about what the benefits of ETFs are. I just talked earlier about accessibility. Well, most individuals in their 401ks aren't actively trading every day. Instead, those investments come in regular distributions and income from their paychecks, which comes every week, every 2 weeks, once a month. So that tradability that ETFs provide don't necessarily mean as much in a 401k plan. What we have seen in 401k plans increasingly that's similar to the ETF market is a greater use of index products and a greater use of low-cost products in 401k plans. So that is ringing true in the way that investors allocate their 401ks in much the same way they're allocating their taxable accounts outside their 401ks using ETFs.
And then speaking of allocation, about 25% of the investors you surveyed in ETFs are going to use them for alternatives. And we've seen a real increase in products that are available to access those types of alternatives. And we're putting them up on the screen here, the types of alternatives that people are looking at here. How many more products are we going to see? How much of a growth area is this? And are there any sort of pitfalls with offering ETFs that offer people access to alts?
I think we hear about alts, and especially all the conversation in 2025 really stemmed around more traditional alternatives, lower liquidity alternatives, private credit, private equity come to mind. But when you look at the chart you have on the screen, what you see at the top of that list are more traditional alternatives of how do you think about reallocating a traditional 60-40 equity fixed income portfolio, bringing alternatives like commodities, like real estate that can provide some diversification benefit over time. And in markets like we've seen most recently with things like gold and silver, perhaps outsized returns. We're also seeing from that younger generation, going back to that millennial investor, other types of alternatives, newer asset classes like cryptocurrencies, the increasing affinity that brings in an account to provide diversification benefits, we are also seeing ring true. Perhaps when you think about the pitfalls, when you think about things like private equity, private credit, we've got to make sure that the underlying securities have sufficient liquidity so that tradability of the ETF doesn't get diminished in what we're providing investors access to.
Yeah, that is really the question for those products. It's going to be an interesting couple of years on that front. David, thank you so much. Appreciate it.
Thanks so much for having me.